All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. Market's just kind of been, drifting higher the entire day after gapping on lower. We really haven't seen it have, anything substantial in terms of, any kind of real sell pressure come in off the gap lower. It's pretty much been all buy pressure out there, a few small exceptions, but it's not heavy volume. It's not anything too different from what we've seen over the last 3 to 4 days. And it sets up, interesting, some interesting stuff heading into earnings season here. And, we kind of saw it kicked off this morning with Citigroup. And, Citigroup and the rest of the banks, saw some early money, even though they gapped down. Saw some early money come into them here today. And, one thing that's for certain, looking at Citigroup is it's a cheap stock. You can make a whole bunch of arguments for a whole bunch of other stuff, but it's a cheap stock. It's trading at a 7 PE, a 7.5 forward PE with a growth rate this year of around 14%. That is just incredibly inexpensive. 3% dividend. It's trading below book value, and it's incredibly inexpensive. We could make that same argument throughout all of 2018, right? And you've heard me talk about the banks for a long time. They are incredibly inexpensive. Their valuations are better than what their valuations were back here. Okay, they're just absolutely better. But this comes down to a sales growth and an earnings growth thing. And, that they need that catalyst to get money into them. Has this correction been enough to ultimately catalyze a nice move in the banks? I think if we see, similar stuff out of Bank of America, JP Morgan, Goldman, the answer is yes. It is common, though, that the way that banks react on their earnings is not ultimately where they go during the quarter. Meaning a lot of times we'll see the banks move higher on their earnings and then kind of sell off the rest of the quarter, or vice versa. So do have to be a little bit wary of that small tendency, but I think it's a tendency that can absolutely get broken given the fact that we see how just incredibly cheap these stocks are. I mean, if we come in, I'll put in Citigroup here, and you can just kind of see where it's been. You can see the revenue, right? The revenue has been on the decline, and that has been the concern. In fact, the sales growth over the last 5 years has been negative, right? But that is where there's some signs of optimism that might change. And price to book value, well, below 1. Right, below 1. It did briefly go above 1 at the beginning of last year, but it's been below 1 for a long time. PE ratio. Here we are with the PE ratio at 14.3, where it sat at the beginning of last year. And you said, well, why is there no PE ratio here? Well, the earnings had been negative, right? So that's what, you won't see a PE ratio. But here's what I was talking about, forward PE ratio down here in the low, single digits, very inexpensive. Price to sales ratio, which, is not a predictor for Citigroup. It really just follows the stock more than anything, but has definitely pulled on back here, significantly. So, it's a cheap stock. It is definitely a cheap stock. Is it one that will will get cheaper over time? Is it one that will see a little bit of change here? Yeah, it sure could. But overall, we are seeing, the buyers kind of stepping in, buying some of these banks, the Citigroup, the JP Morgans, the Bank of Americas here this morning on, after those earnings. We see a little bit of buying coming into the regional banks here as well. So, that is, that's a general positive here for the bulls, and something that I think is definitely noteworthy. but not story defining here just yet. One area of kind of red on their sheet were their trading revenues. Some really ugly numbers there. Trading revenues, some of the lowest we've seen in many years out of Citigroup here today. And, there's some talk and some chatter out there about the correlation between Citigroup stock and the, trading revenues. And then when their trading revenues go down, the stock goes down and all of that. But I'm not a big buyer in of that theory. I don't think that theory holds a lot of water. I think it's one of those where there's just only a few data points, and they're very much in unusual circumstances for the market. Right? They happen. They tend to happen when the market has had something disruptive go on with it. And so I think the story isn't so much their trading revenue; it's market disruption and how that affects the stock more than anything here. But there's a very common picture out there today with a lot of things. And let me just take Lowe's for example. Right, here's a stock that in 1, 2, 3, 4 days has gone nowhere. Just gone nowhere. Yes, I know it's rallied up $1 one day and down 50 cents another day and up, a little bit, down a little bit, but it has gone nowhere in 5 days. Here's Disney. Nowhere. Absolutely nowhere. Yes, every day it gaps down and it rallies, right? I mean, this is day 4. Good luck finding that in a chart where 4 days in a row the stock gaps down and closes up at about the same price every day. Yeah, that is good luck finding that. I'm pretty sure that is something incredibly rare to see. But we see it with Disney. Here's Adobe, right? And you'll notice I'm going different sectors here. 4 days, gone nowhere. J&J, right? Another sector, another group. 4 days, nowhere. Coca-Cola. 4 days, nowhere. Walmart. Nowhere, right? Absolutely nowhere in the last 4 or 5 days. IBM. You get the picture, right? We can go from different market caps to different sectors and different stocks in those groups and see the same thing. Materials, here's Alcoa. Same thing. U.S. Steel, same thing. Halliburton, a little bit different, but 3 days now, right? So there definitely are some that are a little bit different. But in general, there are just a lot of these Lowe's types charts out there in the market. And the question comes down, what's the significance? What's it mean? And which way is it ultimately going to go? Well, there's a couple mindsets that you can take when looking at this. And one popular one when we see consolidations is for traders to use an accumulation distribution line. Now, what is this? Well, accumulation distribution line is basically showing whether the stock's being bought up or sold off. But it basically discounts gaps. So what do you see? Well, you see that here over the last several days, the accumulation distribution line is on the rise, even though the stock has been going nowhere. What's that saying? Well, that's saying that the stock has been bought up throughout the day. There's been buy pressure coming in here on the stock. And so they're saying, look, it's closing near its highs. So the bulls are in charge because it's closing near its highs. Here, it's been closing near its lows, so bears are in charge since it's been closing near its lows. And proponents of the use of the accumulation distribution line will make the argument that, look, if we're consolidating, if we have a stock that's consolidating, and the accumulation distribution line is on the decline, chances are the next move is going to be down. And if we have a stock that's consolidating and the accumulation distribution line is on the rise, chances are the next move is going to be higher. Right? And that is kind of the common way to to look at it, and I think it has a lot of validity. It's like anything technical. It's not a prophecy. It's not a mass predictor. It's something that could definitely fail, and we can find many instances of it failing. But it's a popular way to to look at things. And when we look at a lot of these consolidations in that light, Home Depot, right, suggests going higher. Right. It suggests that the next move out of this consolidation for a lot of these names is likely higher. Right. That's the inference that we would take out of this accumulation. To have, are we going to have some sort of breakout? Right. And that's what a lot of traders will look for from these consolidations. Is a breakout or a breakdown. Is there going to be a break of the trend, right? Well, we can look at some things and go, okay, well, Adobe, they've had some of that. Today, they were breaking down a little. Oh, Friday, they were breaking out a little bit, right? They're trying these little breakouts, these little breakdowns, and not really able to get them. The bottom line is what ultimately determines the break direction just tends to be a catalyst. And when we see so many out there, the way that they are right now, they absolutely need a catalyst. And for many of these, it would not be surprising to see something like this, where you get a Home Depot and it breaks out to the upside and then fails, or breaks down to the downside and then rallies. To have a false break out of these consolidations, if you go look historically, that's very, very common. In fact, it's kind of an easier play than than playing a just the absolute break here out of them. I mentioned on Friday that with a lot of these, the chances of them moving again out of these spots will come on a gap. And we got a gap here this morning, right? Now, I waited to buy a few puts on XLI until the market rallied a little bit, but we haven't seen it kind of turn over and really follow that gap. The market's just kind of on hold in many regards and with many things right here, right now. No new trade war news, no new real movement in the government here in the U.S., no real kind of concrete economic data that suggests anything in the future, right? We had some economic data backwards looking that was reacted to at the gap here today, but nothing really future looking. No real change in the Fed in the last several days. So the market's on hold for a catalyst and looking for a catalyst. And, when you look at the market overall, the tendencies tend to be without a catalyst, it tends to kind of continue in the direction that it's been. And for now, that remains, generally bullish with a lot of compression and consolidation, really kicking into high gear. We have about an hour and 40 minutes left in the market today, and you can see the volume. The volume today will not get up to Friday's volume, probably not even come close. May come a little bit close. But this is going to be one of the lowest volume days in a long time since November. Really since November and the Thanksgiving time period. It'll be the lowest volume since then. What does that mean? Well, it just means that the market is not deciding on anything. We saw the market vibe. Well, the market vibe today is turning neutral. Here, it's been a nice little bullish run, but turning on neutral here today. We still have, turn neutral on Friday, but still neutral here today. Bullish percent index, not really going anywhere here today, not signaling anything bearish, not really signaling anything bullish. But that's what that's what the environment is. That's what we're looking at right here, and it is one where some of the short terms can be argued as overbought. But the longer you consolidate in an overbought condition, the more you wear off that overbought. We're seeing a lot of that here. But bottom line, the market is awaiting the next catalyst, and that catalyst is likely to likely to bring a substantial move. And it could be a whipsaw move. Definitely could be a whipsaw move. But, I think if we see the banks, Bank of America, JP Morgan, we see a positive reaction to the earnings on those. That will definitely be a positive catalyst. But if we do see the banks kind of break down tomorrow as we hear some of the earnings, because that could definitely provide a negative catalyst. And one of the things that we see continually throughout earnings season is you get these days where a bunch of companies report and it drives the market up big. And then there's these days where a bunch of companies report and it drives the market down big. You get these bigger move days, kind of back to back coming in. So I would not be surprised to see a little bit more kind of uncertainty, a little more chop, here in the market as things kind of play out. But anyway, that's kind of where things are, where things sit. And if you take a look at something like the accumulation distribution line, it does suggest breakouts higher. But at the same time, that is not an absolute. My suspicion, right? Just unfiltered suspicion, looking at everything. My suspicion is that we're in for some selling. That's my suspicion. I don't think there's anything to say, hey, you know what, we're going to sell off to X degree into this level and that level and all of that. It's just kind of my suspicion here. We've had all these days of just small gap down, and the buyers have stepped in, I just would not be surprised to see, some of that buyer remorse come into play in the short run on a little bit of selling. But so far we just haven't seen it. But we also haven't seen any selling come into the market. We've seen gap downs. We haven't seen selling. Right, and if we get some selling that comes in, maybe even on a small gap up tomorrow or something like that, I do think the path of least resistance in the short run will likely be lower. But we can see a little bit of a catalyst, and it changed that in a heartbeat, and change that very, very quickly overall in terms of just in terms of the short run here of the market. Okay, going into the close, I have a position on XLI. I bought it when XLI was down about 20 cents. It rallied a little, and then it sold off. It was down 40 cents. Then it was up 10 cents. It's trading at about a 50-cent range here today. Since I entered, it's up about 6 cents right now. Going into the close, just looking at where it is and what's going on with it, I'm going to hold it into the close most likely. I may change my mind into the end or something like that, but I am going to hold it here into the close. I do have to be a little bit careful because I don't have a great stop level or anything like that, but going to hold it here with my suspicion, and look to. This is something I'm looking that could easily come back into below 66, and depending on what's going on out there, perhaps a little bit lower. I don't necessarily want to be holding it when Caterpillar reports earnings. That's one of my, that is my concern. I kind of want to be holding it when Honeywell reports, and I don't want to be holding it when Caterpillar reports. And Caterpillar reports in 10 days. So, have a little time on that. Honeywell reports here, even further, even later than that. Normally Honeywell reports early in the earnings season, but this quarter is going to be a little bit different there. But anyway, going to hold that here into the close. I do have a little bit of cash for another position, but nothing too substantial there. So probably won't add anything given what things look like here. But if for some reason I have to pop out of XLI with a loss, we still have cash to really go after things, and you'll probably see me kind of go after it this way, where I'm using a few more ETFs than individual stocks, and that just simply comes down to the time of year we're in, where a lot of companies are reporting earnings, so those earnings are priced into the options. The implied volatilities on the ETFs have come down substantially, so they're very tradable in terms of getting in and getting out and everything there. So, just to diminish some of the individual stock risk and the option pricing, generally through earnings season, you see me go a little bit more towards companies that have either already reported or into the ETF basket. And so that'll be kind of the path I take here over the next little while. Thanks for hopping on. Have yourselves a great one, and we'll talk to you later. Take care.